Hello, everyone, and welcome to the latest edition of the Formula to Success. My name is Dan Charlie. As you see down in the corner, I'm the host today, also president of Alpine Brokerage. And with me today is my co-host, Josh Lipson. Josh, say hello to everyone out there.
Hello, everybody.
Now, today is a very special day for the Formula to Success. You know, this comes around once a year. And if you haven't heard, or maybe you have been under a rock for the last few weeks, in the last month or two, that November is Long-Term Care Awareness Month. And, this happens every year. And in order to get our advisors a head start on this program, what we have done is put together a jam-packed list today of the premier long-term care speakers and affiliates to talk to you about some of the tips, tools, and techniques that you can use to make Long-Term Care Awareness Month in 2023 your best Long-Term Care Awareness Month ever. Could be your first Long-Term Care Awareness Month ever. Either way, it doesn't matter. Joining me today is Kevin Fisher, the host, author, genesis of Friday with Fisher. Say hello, everyone. Kevin, wave hello. Very good.
Good morning. How are you?
He's regional sales director of OneAmerica. Does a great job for us, and really appreciate you being there today, Kevin. He's going to be kicking it off today, and in addition to that, we have Tim Lockwood, who Tim is the sales vice president there at Lincoln Financial, representing MoneyGuard products specifically. So he is just laser focused on that. So we're really happy to have him. And we've been having some great wins with Tim this year. So thank you, Tim. Appreciate your hard work. And lastly, closing it out is David Smitherman. Now, David, he probably our shortest relationship, but I saw fireworks when we met, David. So I'm happy that we've gotten to connect, and I'm looking forward to having a great close of 2023 with you, and looking for a great 2024 as well. So thank all three of you for coming today. Now, before we get started with their portions of this program, we're going to talk a little bit about the conversation around long-term care. And there is no better person to do that other than Josh in my office. Josh is the vice president of sales. It covers life insurance and long-term care. And we get asked all the time from advisors, I know my clients don't have these products, but I really don't know the conversation to have with them or how to approach them about it. It just, it's let's face it, a little bit of an off-putting conversation if it's not framed correctly. So we have designed and kind of extracted some of the best knowledge that we have around the industry and packaged that together in a way that advisors can understand and really give them a track to run on as it relates to having this long-term care conversation with their clients. So Josh, why don't you take it away, and I'll be back to introduce Kevin, our first speaker.
Thanks, Dan. So thank you, everybody, for joining us, our panelists for being a part of this presentation. Today we want to cover four things. The first thing, we want to identify the opportunity. We want to help advisors see what they're missing by not talking to their clients and providing long-term care solutions. Second, we want to talk about how to initiate the conversation. It's not uncommon for me to hear an advisor say, Josh, I've been talking to these clients for 10 years. I've never talked about long-term care. How do I now bring it up as if it wasn't important for the past 10 years? So we'll talk a little bit about how to initiate that conversation. Then we're going to get into the heart of the presentation and listen to Kevin, Tim, and David talk about what they're doing to promote awareness, provide some sales opportunities that you can use to initiate conversations and maybe identify some clients that would fit. And then last but least, we're going to get you excited to get out there, to engage your clients, to have those conversations, help clients plan for long-term care, and grow your business while you do it. So let's jump in. The missed opportunity. There was a survey that said 90%, 9 out of 10 believe their financial professional should be leading the long-term care conversation. Well, what that tells me is nobody's leading the conversation and clients want to have it. So all we need to do is really start talking about it. So if 9 out of 10 think their financial advisor should be leading the conversation, it shouldn't be a surprise that 9 out of 10 believe it's an important component of retirement planning. So if it's important and they want you to lead the conversation, there's a pretty big opportunity there. Now you can see we've all heard the AARP article that said, hey, 7 out of 10 above the age of 65 are going to need long-term care. And 2 out of 10 is actually going to last, that care is going to last more than 5 years. And the average long-term care the average time that person needs long-term care when they're on Alzheimer's dementia situation is 8+ years. And that's expected to grow as medicine evolves and keeps people living. It's a tremendous opportunity. The need is there and people want to talk about it. It's an opportunity to create a new revenue stream if it's something you're not doing. And if you're an advisor who manages assets, when you protect those assets against the risk of long-term care, you're not only protecting the client's assets, you're protecting the assets that you manage. So how do you enter the conversation around long-term care? And it doesn't really have to be any more difficult than just asking a question, right? It just really have to maybe step outside of that comfort zone because maybe it's something you haven't spoken about before. But most people have had an experience with long-term care. So a great question to ask is just, hey, have you had a situation in your family where somebody has needed care? And then be quiet and let them speak. Most people have a story. You know, you may even ask, hey, listen, have you been in a situation where you provided care? You know, any one of these questions is going to promote that conversation. Why? 90% of people think it's important, and 90% of people wished you'd lead the conversation. So when you open up the door, they walk through it and start talking about it. A couple other questions you could ask. Hey, if you needed care, how would you pay for it? You know, where do you want to receive care? And who's going to provide that care? So there's basic questions there that you can use just to simply engage clients. And it might be as simple as something like, you know, hey, before you let a client go, hey, Dan, before I let you go, let me ask you a question because I'm constantly asked by my clients, you know, what would happen if they got sick and they needed care? How would they pay for it? Do you share those same concerns? Now, we know 90% of people wished you'd lead the conversation. So if you just take the lead, they'll engage in the conversation. Now, we have a separate presentation where we go through the actual conversation, you know, how we suggest you approach it, move the client through the conversation. So at the end of the conversation, they can make the best decision for themselves. So if you'd like to dig in more to that conversation, just reach out. We'll be happy to have that conversation with you. So one of the areas we've seen tremendous change in the insurance industry is in the area of long-term care. And it's really evolved over the years. A number of years ago, there were really only 2 options. One was to self-fund, and the other was to buy traditional long-term care insurance. And as the industries evolved to address the risk and the need to do something about long-term care, so have the products. We've got annuities with long-term care related benefits. We've got life insurance with accelerated benefit riders, maybe allow you to use 2 or 4% of the death benefit if you need it for care. And we've also got life insurance, long-term care combination products, often referred to as hybrids. I guess the most important thing to take away is that, you know, at Alpine, we have all the tools in the toolbox, which means when you work with us, you have all the tools in the toolbox. And the appropriate tool is really going to be specific to your client's unique situation. So we've got all the solutions, you've got all the solutions, and we really just need to start having that conversation. So with that, I'll turn it back over to Dan so he can introduce our first speaker.
Awesome, Josh. Thank you so much. That was amazing. Yeah, it really is as simple as just having the conversation with your clients. You know, if you're not offering these types of solutions, they may be going somewhere else for it and you don't even know. So, all right. Well, I am so excited to welcome Kevin Fisher to the program. Kevin is regional sales director of OneAmerica. They have a very unique platform that has some specific applications in our business, and not to mention that I'll tease this a little bit. You may have heard Josh or I talk about in some of our other programs, the need of storytelling, both you as an advisor telling your personal story and how you can connect with your clients in a better way by them connecting with you through your personal story, whether that's video content or just, in one-to-one conversations, but also telling the story about the products and services that you offer. And I just feel very passionate about that. I think that's, what is going to separate the advisors from, let's say, the AI in the industry. AI will not have a personal story that someone can buy into. You will. So I think that's very important. And you're going to hear just a little bit about it from Kevin, because they're also a company that's buying into it. So Kevin Fisher, welcome. OneAmerica, take it away.
Thanks, Dan. I appreciate it. Thank you, Josh, for having me. Long and short of this thing is we all have solutions, and you're the marketplace. You're our resource for distribution. Regardless of the carrier, be it Lincoln, Nationwide, or us at OneAmerica, we all mesh together and help create, really, if you will, a full blanket of opportunities for you to provide solutions for your client. Fundamentally, we offer a similar approach by using an asset-based strategy, but what we all differ in the way in which we embrace that. We at OneAmerica have been doing this for 35 years, and we have both a life insurance-based product, Asset Care, which we're going to talk about in a minute, and an annuity-based product called Annuity Care. We're the only carrier that is offering both of those on the same platform, and have the ability to swap back and forth from an underwriting perspective. If a certain scenario doesn't fit our Asset Care, it may fill into the Annuity Care market. If you want more about our full portfolio, please reach out to Josh or Dan and at Alpine, and ask for more details. That being said, we are in a unique position at OneAmerica where we can offer strategies that extend from a limited duration, anywhere from 2 years, all the way to an unlimited duration for infinity. That's a fact that infinity can be a long-term care benefit. It's an unusual scenario that's discussed because, quite frankly, most carriers don't really go down that path. We tend to focus on really what concerns a client, and that's the tight, compact window of time. So that being said, I'm going to talk about two very specific opportunities for you. One is an annuity-based solution, and the reason I think you need to know this is that it is the most underserved segment of funding and asset management from a protection perspective in the industry. It's been that way for infinity. The other segment is a unique solution from a funding perspective that we at OneAmerica have, which is for qualified money. I'm going to take those two segments. Hopefully, I can have those done in 5 minutes apiece so you can get back and get on. And then I'm going to share with you a quick little teaser about something we've developed in conjunction with one of our partners that can help you improve your conversations with clients. So let's get rolling on this one. We're going to focus on Annuity Care. That's our annuity-based product. Typically, you see annuities purchased for one of four reasons, as you can see on the screen. That fourth reason really is the newer one: additional catastrophic healthcare benefits. Typically you think of those as an add-on, a nursing home rider, a critical illness rider that you include as part of an income solution. Well, we don't do that. Since 1997, we've offered a true long-term care strategy where we can convert those dollars into long-term care benefits. And I'm going to share with you a little bit how that works. So you have to ask and make sure when you're looking at your client scenario, is there non-qualified money sitting in annuities where it should be? Is it going to be used for income, or is it going to be used as a, if you will, a defensive hedge and a pass-on strategy? Well, according to a Gallup poll, over 70% intend to use that annuity money for a catastrophic illness or a nursing home scenario. That being said, that generally qualifies as long-term care. That general part is that catastrophic illness. Depending on the severity of it and the impact, that may or may not be a long-term care scenario, but it's certainly a nursing home event is a long-term care scenario. In order to qualify for long-term care, we at OneAmerica have to make our policies available to provide for care at home or in a facility following Internal Revenue Code and definitions, making it a 7702B scenario. We all follow that. Lincoln, Nationwide, all of our peers follow that guideline as it relates to our products, both annuity-based products and life-based policies. What we all have to do is have your client qualify, being unable to perform 2 of 6 activities of daily living or have a severe cognitive impairment. And then we can provide tax-free benefits. So specific to this particular scenario, if your client is sitting on non-qualified deferred annuities and they have to start liquidating that in the event of a, let's call it a cognitive impairment, they're going to be taking that in a true annuity distribution scenario. They're going to be taxed on the gain. But if it sits in a specific product, a Pension Protection Act defined HIPAA controlled annuity, we can turn that gain into tax-free long-term care benefits. And it's simply a 1035 exchange. Certainly there's a little bit of underwriting, but long and the short of this thing is we can transform those gains into tax-free long-term care benefits. This is made possible by the Pension Protection Act. That Pension Protection Act went into force, in 2010, so it's been around for well over a decade. And if you think back, we at OneAmerica have been working in this strategy for over 2 decades. We've pioneered this space. Second point I want to make here, not only can we just wash away those gains, we can also extend those benefits by adding our continuation of benefit rider, potentially creating an unlimited tax-free distribution for or from a long-term care perspective. That continuation of benefit rider, as you can see, is optional. It can be funded from that exchange, or you could pay out of pocket. There is a lot of flexibility. Here at OneAmerica, we have a couple of solutions. One is a fixed annuity. The other is an index-based product. If you're working with the index-based product, you're going in, you work through a broker dealer, you're going to have to confirm with them that this, in fact, is available and is an option. Again, in this scenario, I'm just going to show you the wash away of taxes and what this scenario can create from $150,000 1035 exchange. For the client who is 70 years old, this 1035 exchange can generate for her, this is day one, $1 benefit, $6,300 for up to 24 months. Now, here is something to keep in mind. Every year, that benefit amount is guaranteed to grow, contractually guaranteed inside of the product. Now, remember, this is just our simple base only product. If you wanted to add that continuation of benefit rider, we can make that happen. And that continuation of benefit rider can come in a couple of options, a limited duration or an unlimited duration. At OneAmerica, we generally show the unlimited duration simply because that provides for that catastrophic scenario where it may be an Alzheimer's event and you want to have that coverage. Now, each scenario is unique to that person. If they don't care about long and lean and unlimited, fine, we can do short and fat. We can do whatever is right in the client's eyes. The one thing we want to talk about is this. In this particular scenario, if we have 150,000 going into the base policy, it'll provide that a lesser amount if we don't fund the continuation out of pocket in a separate premium. It'll minimize that amount. It'll drag it down to about $4,500. In this scenario, we're just pouring that 150,000 in, and then we're paying out of pocket at an annual pay of $4,300. Incidentally, side note, as it looks to that continuation of benefit rider, being long-term care, it has all the same tax advantages as a traditional long-term care policy. Maybe deductible up to the age-related table if they itemize and they hit the AGI limit. Of course, this is an important element to consider and talk to your planner and your tax professional about, but it is an opportunity there. Inside of this product, remember, base first, we utilize those proceeds, and then we step in and pay benefits out of that continuation of benefit rider. And in this instance, for an unlimited duration of time. Remember, we can do short, we can do unlimited. Lots of flexibility, and that is the beauty of working with this particular strategy. The most important thing I want to point out here is I can utilize the policy to insure two people. It could be my wife's non-qualified deferred annuity funding our long-term care strategy. Think about that. Her money is our strategy. In this case, with an annuity, it's limited to the spouse, but that is a huge, huge opportunity. Second thing I want to point out here, most importantly, underwriting. If we are using the continuation of benefit rider, we will have a phone interview. We will have an MIB review. We will have a prescription verification validation standard for any asset-based product. It's not a guaranteed issue. It's not a simplified issue. We will underwrite that risk. If we're doing a base only, we're going to do an MIB. We're going to do a prescription review, but we're only going to underwrite off of the application and the ineligible condition list, meaning they do not have certain maladies. Like they're a step away from a claim is really what we're underwriting against. There is a lot more to this. I invite you to call Josh, Dan, Alpine Brokerage, get more details. Here's what you need to identify. If you have a client under the age of 85 with non-qualified deferred annuity money, and it is positioned as their emergency fund for healthcare, we may be able to reposition it and make it a more valuable asset to them, even without that continuation of benefit rider. Remember this, by moving something to a Pension Protection Act strategy, you impact not just benefits, but taxes. You reduce that taxable distribution, and you don't impact the most important elements of their strategy, their income and their taxes, and peripherally impact or potentially impact their means tested benefits, being Medicare premiums with an IRMA surcharge or any other elements that are related to that taxable distribution. Now, that being said, I'm going to pivot now completely away from an annuity-based solution, and I want to talk about where we're going to go with another strategy. And that is simply qualified money. Qualified money being 401k, 403b, 457, traditional or inherited IRAs. This strategy is applicable, as I mentioned, for a traditional or an inherited IRA. If you are under 59.5, typically this strategy does not work unless it is an inherited IRA. For more details on any of this stuff, reach out to Alpine. Here's where we're going. Let's say you have a client. They have an IRA at wherever it may be, and they are trying to find a way to fund their asset-based product. Now, we at OneAmerica call it an asset-based long-term care policy. You can call it linked benefit, hybrid, combo, whatever you want, but we call it asset-based long-term care. Generally, it's all the same. What we're doing here is nothing really scientific other than a process. We have a turnkey solution where we can take that $200,000 IRA. And remember, Roth is not in the equation here. We take that IRA, we do a trustee-to-trustee transfer to OneAmerica. We at OneAmerica receive that $200,000. We pour that into a deferred annuity and immediately bonus that 25%. So instantly we go from $200,000 balance to $250,000 balance. Makes sense, right? We're just stepping up right there. From there, we utilize that pool of money to provide funding over a 10-year period of time for our asset care policy. Now, remember, this is a turnkey solution that's integrated. The actual name of this is annuity funded whole life. It's awful. It's not the most friendly name. It does the strategy a disjustice, but whatever, it's for qualified money. And this is just one strategy and one way to get at it. And this is a way to make it turnkey and smooth. As you can see with that 10-year annual distribution, that aligns with Secure Act language for inherited IRAs, whereas in a 10-year window of time, you have to liquidate that inherited IRA money. So over a period of 10 years, we'll take a distribution of $25,000 in this example. That distribution will be considered constructive receipt and a taxable event. So they will get a 1099. So now they have that $25,000 distribution. And what's that going to do? That's going to fund our asset care policy. Now, here's the beauty of that. Once that distribution is made in funding the policy, that policy can be designed any way that they want. They can do a 2-year benefit base only policy. They can do 7 years base plus continuation, or they could do an unlimited duration policy. But here's where it gets better. It can be either an individual or a joint policy. So that $25,000 purchases their asset care policy. Year over year, it continues until the policy is fully funded, and then it's in force, done, and over with.
Hey,
In
Kevin,
this scenario,
can I jump in for a second?
absolutely.
Yeah, I just want to point out to everybody, the uniqueness of both of these strategies in the sense that you can use one person, one spouse's account to cover the other spouse. So, we find that both of these strategies are really very, they're overlooked. They're really the less common ways to solve the long-term care problem. But when the light bulb goes off in the financial professional's mind that these are sources of long-term care funding, now when they're sitting with the client, they're doing their asset gathering, their fact finding, the possibilities on the ways to solve the long-term care problem broaden, multiply, because now all of a sudden you've got these two other funding strategies and the ability to cover spouses who maybe don't necessarily have the account. So just want to jump in and point that out for everybody.
The big thing we're trying to convey here is opportunity for funding strategies. It's not so much the benefit on the backside at the moment, but opportunities for you to transform existing assets that are either earmarked for emergencies or may not even be utilized into a funding vehicle, capitalizing on that and protecting both your business and their income. So it's really an important transition here. And remember, with any asset-based product or linked benefit product, you have the 3 values. You live and you need long-term care, you're going to have tax-free benefits for whatever duration that product plan design calls for. If you die and you don't use all of it or just a portion of it, you're going to be made whole because you get that benefit from either living or death. That's a guarantee. And in every scenario, and at some point in time, if you ever want to walk away, you can get some, all, or even more than what you put into the policy, depending again on the structure of the product. And regardless of the carrier, we all have similar value propositions. So that being said, this annuity scenario, this qualified money scenario is also transferable into a deferred annuity scenario. However, I'm not a fan of it. We can make it work just as easily, but from a tax-free perspective, that earlier discussion is where I believe we should head. Remember, the ideal client here is someone with traditional IRA money, inherited IRA money, up to the age of 80, over the age of 59 and a half. And oh, geez, I totally forgot to mention this. Those distributions, that $25,000, if your client is of required minimum distribution age, they can count toward an RMD. The second note here I want to make is that annuity that we're putting or utilizing for funding is not a single premium immediate annuity. It is a deferred annuity, and we are using an income rider to distribute that money. That way we can count that distribution toward required minimum distributions if that client would qualify from an age perspective. Questions, feel free to reach out to us. We can help you there. Now, I've sucked the oxygen out of the room. I don't have enough time to share with you something that we've developed with our partners at Insight, which is a marketing tool specific to asset care. Asset care being our flagship product that we can fund either single premium or recurring premium, anywhere from 5 to 10 to 20 to age 95 strategy. I'm going to ask Josh to send out a quick little video to follow up so that you can get a feeling for what we're showing. But we will be also introducing early next year the qualified money version of this presentation. I think it's really cool. I've been doing this, being asset-based long-term care, since I had hair. So that's, over 20 years. And the one thing I want to point out here, this is a unique tool where it's dynamic. You can actually, from a dynamic perspective, you can interact with the software, with the presentation to see over durations of time. Hey, if my claim started at age 80 and it went 3 years, how does that look? If we both are on claim, me at 80 and him at 83, how does that look? It's a really cool tool. Check out the video that Josh is going to send out for you all. You won't be disappointed. Any questions, please feel free to let me know. I'm going to turn it back to you, Dan, and thank you for taking time for me. I appreciate it.
Thank you so much, Kevin. I appreciate that. I got to tell you, that Insight report, I know we just kind of, teased it a little bit here, but definitely look out for that coming from Josh, because we have that across all product lines, at least on the life insurance side, and OneAmerica has taken the lead on the asset-based side and put together something amazing. I think one of the unique ways to present these opportunities to their clients. And if I'm not remiss, don't forget Fridays with Fisher. I guarantee there's some good content there for sure. So, all right, let's move to our next presentation. Tim Lockwood from Lincoln Financial Group. I have personally been associated with Lincoln going back almost to the Jefferson Pilot days. So we are big proponents of Lincoln here. We love their story, and we've been with them for a long time. And I think some of the things that Tim's going to go over today, especially if you're a registered rep out there in one of our distribution channels, I think there's something that you may want to take notes on, as well as just some wonderful things that Lincoln has in a way to present these types of ideas to your clients. I think they do a great job of that as well. So Tim, thank you so much for being here today on the Formula to Success, and take it away.
All right. Well, thank you so much, Dan. A big shout out to the entire Alpine team for your partnership here. Josh Lipson, Dan Charlie, and the entire team supporting this group. I really appreciate the opportunity today. Lincoln is really excited as one of the first asset-based long-term care entrants into the market, really creating this space in the late 80s, 1988. Kevin's right there next to us, and we celebrated 35 years earlier this year, and working on many more. So a big thank you to the team here, and really excited to be able to share some things with the group. So at a high level, what Lincoln has done is we've actually begun to build out a portfolio of solutions, and we've historically offered what has historically been viewed as a fixed solution. We have recently, as of about 2 years ago, launched what we call MoneyGuard Market Advantage, and including above and beyond that, really to complement our fixed solution, this guaranteed variable chassis, which allows market participation. Since then, we've introduced transferable benefits between multiple policies and really a hybrid approach to our hybrid solution in a cash/indemnity and reimbursement type of feature. So really today, what I want to walk through are really 3 items that differentiate Lincoln here in 2023 and moving forward. And one of those is a market-linked approach with our MoneyGuard Market Advantage solution. Number 2 is our benefit transfer rider, which allows really a first-to-die solution with a joint feature tying multiple policies together with the ability to transfer benefits. And lastly, I'll highlight how our Flex Care Cash works, where it's a cash benefit embedded with the benefits of a reimbursement contract as well. So let's dive into this. As I noted, we've been celebrating our 35-year anniversary earlier this year. I personally am working on my 17th year with the team. So when you think about these solutions, what are some of the biggest things that we've heard from the marketplace over the years? Well, one of them is, we talk to our agent base and our clients, and what we hear very frequently is, well, I may never need this. I want to self-fund. Or I may never need this. What is the return on my investment should I never need care? So what we've done with our MoneyGuard Market Advantage have really hit both of those common objections that we not only hear from our clients, but is also something that we hear from our financial professionals. Hey, Tim, Josh, my clients can self-fund. They're going to self-insure. Well, what does that really mean? Let's take a look here and meet Jim. And one thing I want to highlight with Jim and what we're seeing across the business is, what is the most important thing with planning around long-term care or extended care needs? Well, it's the ability to get coverage, the ability for clients, your clients, to go out there and monetize their good health. Because these solutions are only good if they're insurable and can actually transfer the risk and formalize a plan. So right now, we're going to take a look at Jim. Jim is right in the wheelhouse of where we're seeing the majority of our business. And you may be surprised that our average issue age for our fixed solution is in the ballpark of 56 to 58 years old. So as we saw the trends of clients beginning to plan at a younger age because they understand that their health is more or less an asset class and it is something that they need to monetize and leverage, we continue to see our average issue age decrease, right? Because when you think about these younger clients in their 30s, 40s, and 50s, what is their first experience or exposure to a care need? Well, chances are that's mom or dad having a health concern or needing care themselves. Maybe mom and dad helping out and dealing with grandma and grandpa. So the light bulb goes off fairly early. And going back to Josh's setup here, we need to get in front of this and take a proactive approach to formalizing an individual's plan. So let's take a look at when we're looking at weighing our options, because what are your clients currently doing? What is the default plan? And with Jim here at 55 years old, he may be telling you, or maybe you've talked to him about dollar cost averaging $10,000 a year over a 10-year period of time to earmark those dollars in the event care is needed, right? So he's in his mid-50s. He's been plugging away at his retirement bucket, building a nest egg. Most of our clients in this age range, and quite frankly, our advisors, understand that for long-term growth, we need that market participation. So he understands market risk. He understands that to have something available and to grow his assets over time, he needs that market exposure. And what we're talking about is potentially needing care in our mid to early 80s. That's Lincoln's average claim time. So he's very comfortable with the strategy of the risk reward. What we're looking to deliver here is safety without avoiding growth. So in this scenario, we're going to stack up what that self-funded plan looks like in the introduction of our MoneyGuard Market Advantage solution. So as we progress here and we look, all right, well, the base strategy here in an investment driven solution or plan would be, you know what, we're going to dollar cost average this into a fund, a brokerage account, and we're just going to plug that into an 80-20 asset allocation, leveraging a very basic bucket in the S&P index. State Street offers the S&P index, where you're just putting that money and investing it in the broad market. Now, in the investment strategy, 10 grand a year for 10 years, so we're just looking at a baseline amount of $100,000. We do got to take into consideration taxes. Those taxes have to be taken considered on an annual basis. So here we're just looking at 24% in federal income tax, might be higher for your higher net worth clients. And then as far as capital gains, we're just looking at those long-term capital gains. And in this example, not going to factor in state taxes. So that is something that Jim, in a self-funded plan with a brokerage account, you'd have to manage that tax exposure on an annual basis. You're also going to have to rebalance that portfolio. In these examples, we're going to look at a quarterly rebalancing strategy, and clearly there are fees involved with either strategy. With this self-funded brokerage account strategy, we're taking into consideration a 1% advisory fee. So this is the snapshot of what Jim's investment strategy would look like. Now, if we look at MoneyGuard Market Advantage, what we're doing here is we're allowing Jim to participate in the market over time to grow his underlying account values. And he's going to be able to do that on a tax-deferred basis. We're also going to automatically rebalance those dollars on a quarterly basis. So that is all automated. And there's no taxes needed to be distributed on an annual basis, because this is tax-deferred growth through a guaranteed variable universal life contract with our MoneyGuard Market Advantage strategy. So in this scenario, as a registered rep, we are giving you and your clients the ability to access over 40 plus variable sub-accounts. Those sub-accounts offer both passive and actively managed sub-accounts for you to build an appropriate asset allocation. For simplification purposes today, we are just going to mirror that 80% allocation with the State Street variable sub-account with that S&P index. So really keeping it very basic. We're going to put that other 20% in a bond fund, meeting an 80-20 asset allocation. So now we kind of take a step back and say, Jim, how is this really different than your self-funded strategy of you dollar cost averaging into a brokerage account where I'm in turn plugging those assets and participating in the market? Here we're doing it on a tax-deferred basis, allowing you to grow those assets and that accumulation value over time. Now, with MoneyGuard Market Advantage, what we're going to do is allow you to participate over time on a tax-deferred basis. In the event you need care, we're going to deliver 4-to-1 leverage on your tax-deferred growth, tax-free in the event care is needed. If you never need care, we're passing on a tax-free death benefit, which also has the ability to grow. So let's take a closer look at this. If we were solely looking at accumulation, right? The accumulation strategy and the accumulation evaluation clearly wins with an investment strategy versus an insurance strategy with MoneyGuard Market Advantage. But what you'll take note to here is that graph, that line, is really fluctuating with the market over time. The big difference is our insurance strategy is going to grow on a tax-deferred basis, where your investment strategy, you're going to have to harvest those taxes and pay those out on an annual basis. Now, there is a slight edge to the investment strategy, but with MoneyGuard Market Advantage, our primary benefit is really tax-efficient long-term care protection. So let's take a look at what this ending value and this solution looks like in the event a care need arises. Because in the event care is needed, with your investment strategy, quote unquote, the self-funded plan, you're essentially spending down that $285,000 dollar for dollar. And that's with the expectation that you were able to fully fund that and we're in in about year 22. We're looking at a 22 roughly year window here of historical returns. So you're essentially spending down that 285 dollar for dollar. In the event we have our market advantage solution in play, we are delivering 4-to-1 leverage on that $240,000 and that accumulated value. So we're knocking on the door of about $1 million in tax deferred growth that is distributed completely tax free for long-term care. So when you look at it, you're looking at a 9-to-1, knocking on the door of a 10-to-1 leverage point on your dollar that you reallocated and dollar cost averaged into the strategy. A really powerful story. And for those clients who say they want to self-fund, they're really looking at this ability to participate, but also take advantage of that upside growth potential. Now, one thing you're going to take note to here, and for any of you that do any annuity business and understand how an income base would step up, what we do is we lock in a guaranteed protected value every year. So if we're looking at this solution, we're actually locking in 2.5-to-1 downside protection every year based on the annual growth rate or the growth in that underlying accumulation value. So in this scenario, Jim, if the markets go sideways, he's got no less than $740,000 or $750,000 to tap into as a protected guaranteed value. So there are several layers of guarantees with this solution, but chances of Jim needing to go on claim with the market down over 37.5% are extremely limited. So generally the markets are going to bounce back. And if anything, we expect to pay out that 4-to-1 leverage point, but you have that safety net that locks in on an annual basis on the policy anniversary date. And that continues to lock in every year throughout the life of the contract. So a clear winner here in the event we need long-term care. Now, some of you might be looking at that orange line. What is that orange line? Well, day one, we guarantee a 3-year bucket for long-term care. That's actually the limit on our cash benefit. So Jim has upwards to $205,000 that he can leverage for a cash benefit, whether that's to pay a family member for informal care or whatever needs he might see fit. Now, the reality is we can actually reimburse for informal care as well. And we can assign benefits, meaning that we can pay our care providers directly. Now, Jim might be that profile that says, hey, Josh, I'm going to self-fund because I don't think I'm going to even need care. Well, in the event we don't need care, this benefit passes on to the beneficiaries completely tax-free. With the investment strategy, you're passing on your account value, wherever that might be. Okay, there could be additional taxes due to that market growth, but here we're allowing you to grow that tax-free death benefit based on that underlying performance with a guaranteed floor on the death benefit. So in this scenario for Jim, he's passing on $365,000 to his named beneficiaries. And with our benefit transfer rider, if his beneficiaries also have a policy, they can actually take those dollars and transfer some or all of those dollars into their existing policy without any insurability or underwriting issues. That's right. His beneficiaries, should Jim never need care, can take some or all of that 365 and roll it right into their existing contract and gain basically guaranteed issue leverage on their dollar. And there's no underwriting. I think that's a key component. And it's totally your client's choice. They not only recover their assets at the first to die, but have that option to transfer those a portion or all of that death benefit into an existing contract or multiple contracts, depending on how that beneficiary designation is split. Now, we've got downside protection here. God forbid, what happens if Jim needs care? I've got a claim right now for clients who put the policies in place about 9 months ago. The female spouse was in a car accident. She's injured in a bad way, and we're executing that claim. In the event Jim needed care early on, he doesn't have anything built up as far as any accumulation. We're day one, we're going to guarantee $205,000. Now we can fund this all the way up to age 75, or 15 years. So a tremendous amount of flexibility on the funding. Jim can also fund unplanned premium without any additional underwriting up to that age 75 or year 15. So a lot of flexibility, and those guarantees lock in day one and continue to lock in as we grow the underlying value. So as we talked about, and I hit several times, Americans are looking for tax efficient solutions. Think about your clients in their 40s and 50s, maybe they're younger, mid 60s, who are looking to reallocate or repurpose some cash flow to put in a tax efficient solution and really plug that gap for that long-term care need. Generally, the long-term care risk doubles down on a lot of other risks when you think about taxes, inflation, and longevity. So you really got to engage with your clients at a younger age. We can start and issue this policy all the way down to age 30. For your older clients, we can guarantee a 3 and in some cases a 5% compounding inflation option on our fixed solution. So we're giving you flexibility and options. Now, I kind of teased this a little bit as we went, but we can dish out and pay out upon claim up to 50% of that monthly benefit as a cash benefit in what we call Flex Care Cash. Not only can we pay that out during the month, but we can pay out cash and reimbursement not only in the same month, but in the same week. We break it down by the day. So the family might be delivering care on the weekends while an agency is coming in on the weekdays. And long term, we also have the ability to pay the care providers directly, which is a big differentiator for us. Those care providers can invoice Lincoln directly. We pay them directly under the reimbursement model. Doesn't really seem like reimbursement, but with technology and the ability to sign those benefits, it's extremely powerful. So this allows the family to come in and deliver care day one with our 0-day elimination period. And then finally, as I wrap up, the benefit transfer rider. One thing I'll highlight here is that this goes beyond couples. Right? This goes beyond couples. So think about generational planning. Think about business succession planning, maybe a buy-sell agreement, right? Or when you look at generational planning, this is a great way to engage with your best clients regarding the next generation. Because if little Johnny or Susie are within issue age range, we can lock in their insurability, most likely going to be healthier, get them plugged in with a smaller policy to lock in that insurability, but also have that longer runway for that upside growth potential. If mom and or dad never need care, they have that ability to transfer their portion of that death benefit into their existing policy. So what we say is we're giving you the ability to take the full death benefit as cash and income, as a return of investment or a recovery of that asset and premium, or take and transfer all of that into the existing policy, or do a little bit of both. All we say is the minimum amount to transfer is $25,000. So an extremely powerful solution when you think about being able to recover all of that premium, and you as the financial professional being in the position to redeploy those assets into the market or to plug any other planning gaps for the family, but also have the ability, even if the surviving spouse is on claim or uninsurable, to roll those benefits in. So we are all about the ability to control and deliver flexibility and options. The Market Link solution really speaks to those younger clients and really gives you that opportunity and puts you in the driver's seat to get ahead of the planning opportunity. So Josh, Dan, really appreciate the time and the opportunity here. I'll turn it back to you and identify some clients in your practice. The best opportunities are generally the ones that are already scheduled on your calendar. Reach out to Josh and we can help put some designs together for you.
Awesome. Thank you, Tim. Thank you. Yeah, I really do believe that, clients and advisors have parallel interests in the fact that, they want things simple and flexible. And I think you guys are really delivering some of that. So appreciate that. All right. Our final presenter in our long-term care formula to success, I guess, LTCI Awareness Month edition is Mr. David Smitherman. David is the regional vice president at Nationwide Financial. And I think it's a great segue to close it out, David, and really excited for you to be here to talk about what Nationwide has available as far as this need is concerned, and why it is so important to Nationwide to support their advisors for these products and services. So thank you for taking your time today. And right after David's, we'll be back to wrap it up. And I hope everybody's getting some great value out of this.
Thanks, Dan. Really appreciate it. And it's an honor to be here with you guys, Josh, Tim, Kevin. A lot of great content here. As you can tell, there's a lot of ways to skin a cat when it comes to the long-term care planning space. And we're happy to be on the Alpine Brokerage platform now. And actually, it's really good timing with the rollout of a brand new product in our portfolio. Just a little bit of background. Nationwide first entered the long-term care space in the late 90s when we introduced our first long-term care rider that can be attached to any of our permanent life insurance policies. Fast forward to about 2013, we introduced our first linked benefit asset-based Care Matters product that we've tweaked and enhanced a couple times since then. But then we just this summer introduced the newest product to our portfolio of solutions, which is Care Matters Together, which is our newest product, and it's a joint life version of the Care Matters product that everyone has come to know over the last few years, or last decade, I should say. So give you a high level overview real quick of the new product, since it is brand new. And then we'll talk about a couple of funding scenarios, funding solutions, kind of ways to find the money, which as you can tell has been the theme of the call today. So Care Matters Together is the first cash indemnity joint life linked benefit solution in the marketplace. And it really creates a nice cost-effective way to cover two lives under one contract, as opposed to purchasing two separate individual policies, which you still can do. And there may be reasons to do that. So we'll talk through a few of those ideas here. So we still do have our individual product for couples, is where we typically see this. But now they also have this joint life solution that has a shared pool of money. So it really kind of takes some of the guesswork out of, who's likely to need care. And if we only have enough money to basically purchase one policy, we're kind of guessing which spouse should we weight the risk towards. So we kind of take a lot of that guesswork out and have a true shared pool of money that either spouse or either insured can use for their care. So here's how it works. It's a little bit different than our individual policy, which we've always talked about when we think about benefit periods. We've always thought of anything between a 2 and a 7 year benefit period on the individual policy. On the joint policy, we're kind of changing the narrative a little bit, just in the aesthetics of how we talk about it. We're talking about monthly payments. And the reason is it's less confusing, I think, if both insureds ended up on claim at the same time, they would actually be going through a pool of money, twice as fast. So if we called it an 8-year pool, for instance, for the 96 month, but both were on claim at the same time, they could actually go through that benefit pool in 4-year period. So the options, you've got 3 options for benefit duration on the new product: 48, 72, or 96 monthly payments. So as obviously it equates to a 4, 6, or 8 year shared pool. But we're just talking about you're purchasing a total number of potential monthly payments that can be split up any way that is necessary out of the policy. So we'll look at a couple of examples here. These are all going to assume a 96-month benefit duration, which has been the most popular since the product launched in June. There's about 70% or so of the apps that have come in have been for the 96 monthly payment options. So let's take a look at what that means kind of visually. In this scenario, we have Monroe and Dolores. They have this joint plan, 96 months. Monroe goes on claim first. So when he goes on claim, he uses 24 of the 96 total monthly payments, or 2 years. And then he either gets better and recovers and comes off a claim, or passes away there at that 2-year mark from claim time. And then that leaves 72 payments, or 6 years for his wife, for Dolores in this example. So just splitting it up, kind of a nice 2-year for him, 6-year for her, kind of gives her that total of 96 monthly payments. Next scenario is you could have the first spouse, Stephen, goes on claim and is on claim for 42 months. He receives 42 monthly payments. But at that same time, his spouse goes on claim when there's a concurrent claim. So at that point in year 2, and for the next year and a half or so, till we get to that 3.5-year mark where either Stephen recovers or passes away, each spouse is receiving the monthly payment. So we don't divide it by 2. Each of them would be able to receive the monthly benefit, no matter what that is. And then you can see at that point, Michael would still be on claim for another few years after Stephen's passing. So this is a scenario where, again, total of 96 months, but there's a little bit of an overlap and concurrent claim there. And then this question always comes up: can one person use all of the benefits? And that answer is yes. So in this case, John goes on claim first and has an extended claim, and he goes through the entire 96 monthly payments. It could be the inverse of this, which is very common, where one spouse passes away without needing long-term care. And then the surviving spouse would then have access to that 96-month or 8-year pool of money for his or her care. One thing I will point out on this, in this scenario, the policy would be exhausted. The LTC benefits would be, there would be no more LTC benefits in the policy. There is a residual death benefit, which we'll touch on here in a few slides. But I've had it asked, if one person, in this case John, uses all the benefits, does that mean there's no benefits left for Laurie in this case? And the answer is it depends. We pay all our benefits as a cash indemnity payout, so we're paying the full monthly benefit every single month, unless you tell us otherwise, for the duration of that claim. So there could be a situation where, in this case, for example, John is getting paid more dollars out of his policy, being cash indemnity, than his actual cost of care is. So like if his cost of care was $10,000, if his monthly benefit was $10,000 a month at claim time, but his cost of care was only $6,000 in any given month, he keeps that $4,000 of excess benefits. They can put that in a brokerage account, put it in a savings account, escrow it, save it for later. So there could still be dollars available that came out of the policy after he exhausted the total pool of money that still could be used and payable for Laurie's future care. So just point that out. One of the benefits of cash indemnity benefit. Everything in this product, Care Matters 2 or Care Matters Together, is fully guaranteed. So guaranteed premium, guaranteed LTC benefits, guaranteed inflation if you include it. The death benefits are guaranteed. And then that last bullet point, guaranteed accumulated LTC benefits if premium payments ever stop. Essentially what that means is there's a reduced paid up option. So if they got through 7 years of a 10 pay, for example, and didn't want to pay the last 3 years of premium or had a hardship and couldn't afford it, they would have an option to either fully surrender the policy and take whatever their cash surrender value is as kind of a walkaway, or if, assuming they've paid enough to meet the monthly benefit minimum, which is $1,500 a month, which in this case they would if they paid 7 out of 10 years, they could have a reduced paid up policy where the benefits basically reset almost to a pro rata basis, and the policy's locked up and guaranteed from that point moving forward. I mentioned all of our LTC at Nationwide's cash indemnity. That's whether it's Care Matters Together, Care Matters 2, which is the individual policy, or any of our long-term care riders. So with that, we will pay the full maximum monthly benefit every single month. We do not ask for receipts, and those benefit dollars can be used for whatever that client deems necessary. So the one thing you want to be aware of is the amount that can be collected income tax free is the amount, the maximum of either the IRS per diem, which this year is $12,600 per month, or total cost of care incurred. So if you do exceed the $12,600 a year, that's this year, 2023, $12,600 a month, excuse me, but your cost of care actually exceeded that amount as well, as long as you validate that, keep that with your accountant. I will say Nationwide doesn't ask for receipts at claim time, but you probably benefit the client, behoove the client to keep them for their record keeping, just in case you end up in one of those situations. Having said that, most of the policies we are issuing today are well below the $12,600 a month IRS per diem limit for 2023. Typically, we're seeing policies issued with a $4,000 to $7,000 a month, give or take, monthly benefit. So even with inflation, it would take years before the policy benefits actually exceed the $12,600 per diem that we are at this year in 2023. And that number typically indexes up each year a little bit. All right, a couple key features here, and then we'll get into a few funding ideas. So here are the different payment options we have on this. You can do single pay, 5 pay, 10 pay. We do have a new option, which is a 20 pay option, which we have not had on our individual policy in the past. And then we also have a pay to age 100, which actually looks really good and compares nicely to like a traditional long-term care, standalone long-term care policy. So if you're looking at a client, maybe it's kind of that budget, you're trying to find a budget-friendly approach, get that cash flow or that premium down where they can cash flow it and into a bite-sized tolerable chunk. Take a look at that pay to 100. You can pay annually or monthly, and we do not have a monthly modal factor. So if you run any of them on a monthly basis, there's it's just the whatever your annual premium was divided by 12, no modal factor, so it's not grossed up any if you choose a monthly option. Big call out down here at the bottom, and this is different than Care Matters 2, our individual policy, which does not really have a waiver of premium benefit. With Care Matters Together, the new joint policy, no matter what option you elect, obviously a single pay, it's a moot point, but any of the other options, full waiver of premium is built into the policy. So once either insured is on claim and receiving benefit payments, premiums stop until or unless they come off of claim or pass away. So full waiver built in, really strong feature that did not exist on the individual product previously. So really happy about that. If one person dies or comes off a claim, there's no catch-up premium, no back premium, no interest due. They just the survivor, if they're both still alive, they just resume the original premium, and it's still scheduled to end wherever the end point would be. So, for example, if they went on claim in year 15 of a 20 pay, for instance, and the first person was on claim for 3 years, so that carries them to year 18. They didn't pay premium those 3 years, but in year 18, if that first insured dies, the survivor would pay the premium for the last 2 years, and then the policy's paid up. So they basically skipped 3 years of premium on a 20 pay chassis. They paid 17 payments because for 3 of those 20 years they were on claim. So we don't defer it to the back end. Whatever your scheduled end date for your premium duration is still your scheduled end date. Really nice benefit. Most of the products we sell include inflation. Sometimes, if just based on the issue age, we will keep it off. But I'd say, generally speaking, if they're younger than 65, typically we're going to have inflation on the Care Matters portfolio of products. We do have a new option, that 3% for 20 years, and that works really nicely for those couples that are in the 60 to 65 year age band, where average claims are about 80, 85 years old, somewhere in that ballpark. So this is a lower cost inflation option. Benefits are going to compound for 20 years, and then they're going to cap and be level thereafter. So for somebody who's 60 to 65, that basically gets them to claim age on average. So that's a nice low cost option. And then we've got 3% and 5% for life on there as well. 3% compound for life has been the most popular, especially on those younger ages. I think it was Tim who mentioned average ages in the mid to late 50s. We're seeing that younger age, that average issue or purchase age being pulled down over the years, especially now that we have these flex pay options where it's not a lump sum only. I mentioned earlier guaranteed minimum death benefit. So this is a guaranteed residual death benefit. It's 10% of the original specified amount, which is that first bucket of money on here. So that's going to be paid out as long as the first bucket of money is depleted, which on the joint product will either be a 3 or a 4 year base. Then the 10% residual death benefit will pay out even if they've exhausted the entire LTC pool. If they've gone through the entire 48, 72, or 96 monthly benefits, 10% of that original bucket will still pay out as a kind of a final expense. And it is uncapped. I was working on a quote yesterday, nice size case. The original death benefit was over $300,000. So the the original death benefit was over 300. So the residual was over 30 grand. So it is uncapped 10%. I'm going to come back real quick to this slide because I'm going to finish on that. Before I do, one thing I will call out on the elimination period, this was kind of a unique one in the industry. So we do have a 90 calendar day elimination period for Care Matters Together as well as Care Matters 2. But it's retroactive to day one. Okay. So we will pay. So essentially the first check the insured or the owner will receive from us when they go on claim after they clear the 90 days. So you can see month 1 over here in this example, we pay nothing. Month 2, we pay nothing. Month 3, we pay nothing. But in this case, assuming a $10,000 a month benefit at claim time, the first check the client would receive from Nationwide would be 4 months worth of benefit. 3 for the 90 days that they were on elimination period, plus month 4 being their first true month to claim. So in that case, $40,000 cash would go to them, which can help a lot. I mean, they can help with home modifications, travel costs, you name it. So retroactive to day one, as long as they clear that 90 days. And then you can see thereafter, month 5 and 6 and so on, it would just revert back to the regular monthly benefit. Real nice benefit feature there. All right, last thing we'll end with, and kind of a funding scenario, kind of sales idea topic. So there are potential tax advantages with Care Matters Together as well as Care Matters 2. When you look at these products and you look at the illustrations, you'll see just a base annual premium. But there's 2 components to that. There's part of that is considered life insurance. Part of that is considered tax qualified 7702B LTC premium, which gets the same tax treatment as like a standalone traditional LTC policy premium would. So why is that important? Well, it brings in some tax advantages that may not be available, like using a long-term care rider on a life policy, for instance. So where we see the opportunity here, Kevin mentioned earlier, there may be some individual taxpayer deductibility. However, he also mentioned you have to meet or exceed the 7.5% AGI floor or threshold, and then there's age-based limits that apply on top of that. So generally speaking, it's hard to deduct any of these LTC premiums on Care Matters on an individual taxpayer tax return basis. However, as an individual, if they have an HSA account, they have a health savings account, which are becoming extremely popular, more and more popular, every year. This tax qualified LTC premium is something that is an eligible expense, kind of eligible healthcare expense, where they can get a tax-free reimbursement out of their HSA to help offset some of the cost. So another way to think about it, there are age-based limits that apply for that, but it's a way to kind of purchase your LTC, your Care Matters policy with discounted dollars. You're purchasing some of your policy with tax-free payments, which is really nice. So there are age-based limits that apply to that. I can tell you the sweet spot is really ages 61 and up. If you get to that age 61 to 70 band or higher, you start to see some real nice benefits. 51 to 60 is not bad as well. But that you got anybody in the mid to late 50s and up is where they'll start to see some nice opportunities there from a reimbursable amount out of an HSA tax-free. 2 other things, flipping the script a little bit. Business owners. We have found a lot of success talking about long-term care and finding the funding, kind of looking for that funding source. And again, using discounted dollars by using businesses to fund the premiums. And there's kind of 2 ways you can go on that. They can fund if the business buys a policy on the owner, there is potential tax deductibility to that business. It depends on if the business is a C Corp or any sort of pass-through. So if it's a C Corp, it's great. The LTC premium is fully deductible, irregardless of any age-based limits. So that's really nice. If the business is a pass-through, it's an S Corp, an LLC, partnership, sole proprietorship, et cetera. Partial deductibility, partial or full, depending on the amount, the deductibility does exist But it again is subject to that same exact age-based table, age-based limit table that applies to the HSA distributions as well. So if we're using, if we're working with a pass-through, typically we'll see a flex pay option, like a 10 pay, for example, so that we can have some deductibility and spread that out over time, so that we're not, we're kind of maximizing the age-based limit amount. So we can deduct it every year for 10 years, for example, as opposed to doing a single pay or 5 pay where we're going to leave a lot of deductibility on the table. So great funding source. People typically like to pay for anything they can out of a business account as opposed to a personal account. A lot easier to write that check, a lot easier to get on that program. Second thing on businesses, we can use this as an executive carve out on a non-owner. So if you had a business that had, you know, a group of key employees, you can discriminate with this, and they wanted to incentivize, you know, 4 of their key employees to stay with them and give them an added retirement bump, retirement benefit. You can use Care Matters to do that, where if they stay with the company, it's almost like a 162 plan. Company funds the policy, company gets a write-off for the full premium. Life insurance portion is considered a taxable bonus, just like a 162. LTC portion of the premium is considered an accident and health plan, fully deductible to the business. So the full premium is deductible to the business. The employee, that's not an owner, non-owner employee, critical point there, only has to report the life insurance portion of the premium as income. The LTC portion of that premium, which on Care Matters together is the majority of the premium, it typically will make up 60 to 75% of the overall premium outlay. That part is tax-free to them. They own their policy, fully portable, and all the benefits that come out on the back end are tax-free as well, because they've been paying tax for that life insurance portion along the way. So it's kind of a triple whammy, nice tax advantage where business fully deducts it, employee only reports partial, and this is the smaller part of the life insurance premium on that case design, and all of their benefits they derive outside down the road, whether it's death benefit, long-term care benefit, et cetera, are income tax free. So we also can set up list bills. So if we have 3 lives or more with a common business, we can list bill the company. Which is a nice, easy way to make it company. We just build the company once. They send us cumulative premium. We break it up on our end internally at Nationwide from an accounting standpoint. So business owner market is ripe. We've found a lot of great opportunities, and they come in bunches. Typically, we see these multi-life cases growing. Spouses can be included as well, as dependents of the owner or as dependents of the employee that derive the same sort of tax treatment. So typically see cases grow in size where we start with, I got a guy, or I just need a quote, find out they're a business owner, they have 2 or 3 partners, they're all married. Now we're running 6 or 8 quotes for the same kind of case. So great opportunity there. Get with the Alpine guys. They have our full tax guide, and I'll send out a couple of follow-up sales ideas and pieces on that as well. Dan, Josh, that's all I got.
Awesome. Thank you, David. Yeah, I think that, just closing it out today, talking a little bit about, what's the opportunity. You can see very clearly that whether it's annuity focused or qualified funds or a more market driven product or, something for business owners, we are able to provide solutions for your clients. And now with the track to run on that we have, which is the long-term care conversation, it really gives you the tools that you need, plus the solutions for your clients, and thinking about, all the opportunities that they have to fund this type of risk. And again, I'd be remiss if I didn't say that if you had any questions, contact Josh. There's his contact information on the screen today. And I'd really like to, first and foremost, thank each one of you, David, Tim, and Kevin, for being on the Formula to Success. And with that, again, I'm Dan Charlie, president of Alpine. Appreciate everything from everyone. Thank you all for attending, and we'll see you on the next Formula to Success. Thanks, guys.